Before we start, let's get something uncomfortable out of the way. Wealth is not built by working hard. It's built by owning things. And most people will spend their entire lives confusing the two. You can start broke. You can start in debt. You can start in a small town with no connections and no rich relatives. It doesn't matter. Because wealth isn't a personality trait. It's a system. And systems don't care where you begin. They only care whether you understand the rules. Right now, we're living in one of the strangest economic periods in modern history. Inflation quietly eats savings. Housing prices detach from salaries. Stock markets rise while wages crawl. Social media sells you overnight success while the math quietly says otherwise. So if you're trying to build wealth without understanding the machine, you're inside. You're playing chess without seeing half the board. Today, we're breaking down 9 steps that virtually guarantee wealth, not fast wealth. Not flashy wealth, but structural wealth. The kind that compounds. The kind that survives recessions. The kind that doesn't disappear when the algorithm changes. And it starts with something most people ignore. Step 1. Accept the brutal arithmetic. Wealth is not about how much you make. It's about the gap between what you earn and what you keep, and what that gap earns for you. If you earn $50,000 and spend $49,000, you are mathematically trapped. If you earn $50,000 and invest $10,000 every year at 8% annual return, in 25 years you're looking at over $730,000. Same salary, 2 different futures. The first person thinks they need a raise. The second person understands compounding. And compounding is step 2. Step 2. Own assets that produce. Money sitting still is slowly dying. Inflation guarantees that. But money attached to productive assets, businesses, equities, rental property, intellectual property, multiplies because it participates in growth. When you buy a broad stock index, you're not buying a ticker symbol. You're buying thousands of companies hiring people, selling products, raising prices, expanding globally. You're plugging into the engine of capitalism itself. Historically, broad markets return roughly 7 to 10% annually over long periods. That doesn't sound exciting. It sounds boring. That's the point. Boring, repeated for decades, becomes extraordinary. Step 3. Increase your earning power faster than your lifestyle. Here's the irony. Most people upgrade their lifestyle at the exact speed they upgrade their income. New job, new car, better apartment, slightly nicer vacations. The math never changes. Wealth builders reverse this. They treat income growth as fuel, not permission. They deliberately delay visible upgrades and channel raises into assets. For the first 10 years, it looks like nothing is happening. Then compounding bends the curve. At 10% annual returns, money doubles roughly every 7 years. That means the hardest phase is the beginning, when your investments feel small. After a decade, growth accelerates without you working harder. Step 4. Avoid catastrophic mistakes. Wealth building is less about brilliance and more about survival. One bad business partner, one over-leveraged property, one lifestyle inflated entirely by debt, and the compounding engine stalls. Notice how many get-rich stories disappear quietly after 5 years. Debt can accelerate wealth, but only when attached to assets that produce more than the debt costs. Consumer debt does the opposite. It compounds against you. Credit cards at 20% interest are not convenience tools. They are reverse wealth machines. If compounding is gravity pulling you upward, high-interest debt is gravity pulling you down. Step 5. Play long games in growing arenas. Not all effort compounds. A job with no skill growth plateaus. A shrinking industry slowly erodes opportunity. A business built entirely on trends expires when the trend does. Wealth builders position themselves where growth is structural. Technology, infrastructure, energy transitions, global supply chains, healthcare innovation. They don't need to predict the next hot stock. They need to attach themselves to sectors that expand over decades. If an industry grows 5% annually for 30 years, and you own part of it, you're riding a rising tide. If it shrinks 3% annually, you're swimming upstream forever. Step 6. Understand time as your unfair advantage. A 22-year-old investing $300 a month at 8% could end up with over $1 million by retirement. A 40-year-old investing the same amount won't come close. Same discipline, different time horizon. Time magnifies small decisions. This is why starting imperfectly beats waiting for the perfect plan. Delayed investing doesn't just lose years, it loses compounding layers. Each year you delay isn't 1 year lost. It's decades of future growth lost. And here's the uncomfortable part. No one feels urgency because the consequences are invisible at first. The math is silent. Until it isn't. Step 7. Diversify against your own ignorance. No one can consistently predict markets, recessions, technological disruptions, geopolitical shocks. The illusion of certainty is expensive. Diversification isn't about lowering returns. It's about staying alive when you're wrong, owning different sectors, different geographies, different asset types. When one collapses, another often holds. Wealth is built by those who remain invested long, enough for probabilities to work in their favor. Missing the 10 best days in the market over decades can cut returns dramatically, and those best days often happen during periods of panic, which means emotional discipline is not optional. It's structural. Step 8. Separate identity from income. This one is subtle. If your identity is tied to appearing successful, you will spend to maintain that image. If your identity is tied to optionality, freedom, control, autonomy, you will invest to expand it. Wealth buys time. Time buys choices. Choices buy peace. The irony is that visible consumption often delays invisible freedom. A luxury car depreciates. An index fund appreciates. Only one increases your future leverage. Step 9. Let scale do the heavy lifting. At some point, your labor becomes less important than your capital. This is the shift. In the beginning, you work for money. Later, money works for you. Eventually, your returns may exceed what your job pays. That's not fantasy. It's arithmetic. If you accumulate $1 million invested at 7%, that's $70,000 a year in average growth without clocking in. The goal isn't to quit working tomorrow. It's to reach a point where working becomes a choice, not a necessity. And here's where hype collides with reality. There are no secret stocks, no guaranteed crypto shortcuts, no underground strategies reserved for insiders. The system is public. The math is transparent. The discipline is rare. Most people don't fail because the path is hidden. They fail because the path is slow. Zoom out. Over the last century, markets have crashed, wars have erupted, currencies have devalued, governments have changed, and yet productive assets have continued to grow in aggregate. Because human productivity grows, innovation compounds, population compounds, technology compounds. And if you own a slice of that productivity, you compound with it. But if you only trade time for money and consume everything you earn, you remain outside the engine. That's the uncomfortable truth we started with. Wealth is not about brilliance. It's about positioning. Positioning inside systems that expand. So the real question isn't whether you can start from zero. It's whether you're willing to think in decades instead of months. Because the math will work either way. The only question is, will it be working for you or against you? And that question becomes heavier the longer you wait. Because here's something almost no one talks about. The system does not pause while you decide. Inflation compounds daily. Asset prices move regardless of your hesitation. Opportunities shift quietly in the background. You are always participating in the economy. The only choice is how. Either you own productive assets, or you rent everything from the people who do. There is no neutral position. Think about housing. If you don't own property, you pay rent to someone who does. If you don't own equity in businesses, you buy products from companies whose shareholders collect the profits. If you don't own shares in infrastructure, you pay tolls, utility bills, subscription fees, all flowing upward to capital owners. Ownership concentrates. Consumption disperses. That's not moral. It's mechanical. And once you see it, it's hard to unsee. Now zoom out even further. Technology is accelerating. Automation is replacing repetitive labor. Artificial intelligence is compressing certain job categories while expanding others. Global competition is increasing pressure on wages in many industries, which means relying solely on earned income becomes riskier over time. The safest long-term position isn't a job title. It's equity, ownership of things that scale beyond your personal hours. And this is where most people miscalculate risk. They think investing is risky, but not investing is a bet too. It's a bet that your income will always rise faster than inflation. A bet that your industry will never shrink. A bet that your health will always allow you to work at full capacity. That's an enormous, concentrated risk. Diversified ownership spreads that risk across thousands of productive entities. It's less dramatic, less exciting, much more durable. Now let's address the silent objection. What if I start small? Good. Small is fine, because wealth is not built by the size of the first investment. It's built by consistency of the system. Someone investing $200 a month consistently for 30 years will outperform someone investing $5,000 sporadically based on emotion. The market does not reward intensity. It rewards persistence. And here's the quiet irony. The wealthy often appear patient because they understand the inevitability of compounding. The impatient often appear busy because they're trying to force acceleration. But compounding cannot be rushed. It's like planting a tree. For years, it looks like nothing is happening. Roots are forming underground. Then suddenly, growth becomes visible. Most people quit in the root phase. Now let's talk about volatility, because this is where discipline is tested. Markets fall, sometimes 10%, sometimes 30%, occasionally more. During those moments, headlines scream. Fear spreads. Selling feels rational. But historically, every major downturn has eventually been followed by recovery and new highs. Not because markets are magical, but because productivity and innovation continue. The companies adapt. Inefficient ones die. New ones emerge. If you own a broad slice of the system, you benefit from that renewal. If you panic and exit, you convert temporary volatility into permanent loss. The difference between wealthy investors and average investors isn't secret information. It's emotional control during predictable chaos. And predictable chaos will come. It always does. Which brings us to the bigger implication. If more people understood these 9 steps deeply, consumption patterns would shift. Debt would shrink. Patience would rise. Financial media would lose some of its drama. But drama sells better than discipline. Get rich quick spreads faster than get rich slowly and predictably. Because slow systems require faith in math. And math is quiet. So where does that leave you? Not inspired. Not hyped. Just informed. You now understand that wealth is a function of savings rate, asset ownership, time, risk management, and emotional stability. None of these are mysterious. None require extraordinary intelligence. None depend on where you started. They depend on whether you align your behavior with the arithmetic of compounding. And here's the final layer most people never consider. At some point, wealth stops being about money. It becomes about insulation from volatility, not just market volatility, but life volatility, job loss, health issues, economic downturns, family emergencies. Assets provide shock absorbers. Without them, every disruption feels catastrophic. With them, disruptions become manageable. That's the real leverage. Not yachts, not headlines, not viral success stories. Resilience. And resilience is built quietly, through systems that look boring in the short term and powerful in the long term. So we end where we began. Wealth is not a miracle. It's a structure available to anyone who chooses to operate inside it long enough. The system will continue compounding with or without you. The only unresolved question is this. 10 years from now, when the math has fully revealed itself, will you wish you had started today?